Hi, I'm Murdoch, and thanks for listening to The Rate of Change with York Wealth Management. Hi, I'm Murdoch Gaddy, and welcome back to The Rate of Change. The Rate of Change is a podcast which explores the ever-shifting momentum of financial markets through the eyes of the leading managers in wealth management. In today's ROCast, I'm really excited to speak with Josh Manning, the founder and portfolio manager at Manning Asset Management. Manning Asset Management is an Australian-based fund manager that specialises in investments in the private debt markets. They have an all-weather strategy approach that targets an interest and income return within the fund of 5% above the cash rate. This fund is income generating, pays distributions monthly, and has consistently delivered 5% in income over the past 6 years. I think you will find Josh is an insightful speaker, really knows his stuff in the private lending space. If you like what you hear, please reach out to me with your thoughts and questions at mgatty@ywm.com.au. Before considering any investments, we encourage you to both listen to the disclaimer at the end of the ROCast and seek professional advice. We would like to reiterate that this ROCast isn't designed nor is it intended to be specific advice. I hope you really enjoy the discussions as much as I did, so relax and enjoy the conversation. Josh Manning, welcome to The Rate of Change with York Wealth Management.
Thank you for having me.
Why don't we start things off by you telling us a little bit about who Josh Manning is, your background and your journey into financial markets?
Excellent. Josh Manning, I'm the portfolio manager at Manning Asset Management. We're Australian fixed income and credit manager. So my journey into financial services, I guess, started when I left university. Lucky enough to work at a number of institutions like Macquarie Bank, and then more recently a very large asset consultant called Jana, which is advisors of many of the largest institutional investors in Australia. The journey into Manning Asset Management really started back in 2015. I was working for Jana at the time, and I saw a gap in investor portfolios, and that gap was really in that in assets that you can put into portfolios which genuinely do perform through the cycle. So genuinely have that capital stability attributes, but can deliver an attractive income-based return. So it can really play a very valuable role in adding diversification, complementing existing sort of stocks, bond, property type portfolios. But really delivering on that income type objective. And there's a number of assets that historically played that role, but I felt like there wasn't really enough. Portfolios quite barbelled, sort of low risk and high risk. So there was a real gap there. And at the same time, I also saw the changes in financial markets, specifically in the banking sector and the non-bank sector, and that creating investment opportunities that I personally was very excited about investing in and started investing in. And thought there was a real gap for a specialist fund manager to really focus on that sector. And there was born Manning Asset Management.
Perfect. Yeah, okay, so with the landscape, that's a really interesting one. So when did you see this actually change? Was it after the GFC? Was it most recently, like with 2017, where the bank said, look, we don't want the risk on our book anymore? Like, what specifically in the landscape saw this opportunity? And why did you think a fund was best instead of like just going private or,
Sure.
Yeah.
Sure. Yeah, like it's quite interesting. Like when I started or was starting the business, I did a couple of research trips to the US, where the banking system has evolved and changed and very different to the Australian banking system in terms of a number of factors. But one very important one is the split between the traditional banks and the so-called non-banks. So they are lenders, they directly compete, but they're regulated quite differently for a variety of reasons. Most notably, those non-banks can't accept deposits. So they're a different construct than a bank, and therefore have different regulations around them. In the US, about half of the loans are originated by banks and half by non-banks. Whereas you compare that to Australia, and while it is changing, it's still largely about 90% of loans originated by Australian banks and 10%, but very quickly growing by the non-banks. And those non-banks are an interesting space because there are some really interesting credit and fixed income opportunities that those non-banks offer in order to fund the loans that they originate. And I saw that really in its infancy, but having quite a high degree of sophistication. And I thought that is an area that really is going to boom. And it is particularly attractive from that investor perspective that I talked about before. And I sort of married those two up and thought, okay, this is really going to be a booming sector. And I don't think it's sort of like a point in time. I think the regulations, there's a lot of changes in regulations that have continued to support the non-banks, and I didn't see that abating. So, as I say, I thought there was a really attractive opportunity for a broad cross-section of investors to access these opportunities, and the fund was designed to extract that.
Yeah, very, very nice. So when you say the fund was developed to extract that, which loans essentially, was attractive for you? Like, are you looking at corporate loans? Are you looking at retail loans? What specifically, in an ideal world, if someone knocked on your door and said, look, we would love some money, who would you like to lend to? Like, what does your avatar, I suppose, of your ideal borrower look like?
Yeah, so I think that the sort of founding principles of the business is, what are we trying to do for investors? Yes, there's all sorts of consumer business, structured finance, every type of loan under the sun, but what are we really trying to do for investors who we work for? And that is, we're trying to give them a asset or a fund that we genuinely believe will perform through the cycle. So that means it's genuinely, when we enter an asset, we think even in an adverse environment, we are going to get 100% of our money back when the loan matures. And that naturally puts a lid on the types of assets we can go into. So we can't go into things that are speculative, that are, high risk, areas that are, sectors that are very cyclical. We've talked about mining before, property development's another really good one, where in the good times it's good, in the bad times there is issues. And that just naturally creates a risk aversion to those sectors. You're looking at from the other side of the thing, we're also not looking for a government bond that's delivering 1%, 2%, 3%. We really think there's a really attractive place where you can be in between those, delivering a higher rate of return than those very low risk, very long duration bonds, but not having to go right up the risk spectrum into some are very cyclical, high return, but high risk products. So that means that if we want to play in that middle space, where we do provide an attractive rate of return, but that capital stability, then we really need to find things that are typically asset-backed. So we've got security over a property or an asset or something like that. They need to be very sensibly structured in terms of how we actually manage those loans and making sure there's the right governance around them. We need to make sure that there's a strong alignment of interest, that we're not sort of pulling in opposition to the borrower. And I think most importantly that the loan makes sense for the borrower. There's a lot of sort of lending out there done on an asset basis where people just think, well, I've got an asset there, it doesn't matter. Kind of if the loan makes sense, I'm secure. I think some of those attributes are troublesome, and as I say, we like to stay away from that. So it's really sensibly structured loans where we have a strong asset backing to good borrowers, where we know with a pretty high level of conviction that we will get our money back even in an adverse scenario. That's kind of high level what we're trying to, where we play.
Yeah, so on that as well, if you think about the type of people which you're lending to, right? So with the portfolio now, like how many loans are actually in the portfolio, and what size parcels are you looking at in what would the average be, or what would the minimum you lend to? Is there any maximum? What would that be?
Yeah, so there's definitely maximums, and that's because we want to make sure there's sufficient diversification in the portfolio, and there's not so-called concentration risk. We don't have a big position to one particular borrower. What we think is the really attractive place to be is in purchasing pools of these loans. So this isn't just having $1 million loan to somebody, but for example, in the consumer loan space, we might buy $10 million worth of numerous underlying $30,000-$40,000 personal loans to buy a car for a variety of different reasons. But these very, very diversified pools of loans where you don't have the concentration risks, and there's a lot of sort of structural protections when we purchase these asset pools that provides that level of capital stability. So I don't know what the stat is. I think there's about 8,000 different underlying exposures in the portfolio today, which is great from a diversification perspective. But the key thing that we're really looking for is that what are the capital preservation characteristics of this transaction? And when we stress test it, looking at a number of different historical and future-looking scenarios, do we have that conviction around being able to realise our capital on time? And that's the real test that we put it through.
So you talk to essentially the capacity to have an investment that can withstand the cycles, right? So what happens if you have an asset which you lend to in the portfolio, I suppose sours, right? Something happens. What's the risks around that, or how do you look at mitigating against that risk? Do you take? Is it only first mortgages? Is it second? Is it syndicated? Do you mind giving our listeners a bit of colour of?
Yeah, sure.
How they protect against those interests?
Yeah. So the thing about us is that we're not just a property development or a consumer loan specialist. We have capabilities right across the spectrum. So we look all across the different assets, consumer loans, business loans, property-based loans, and we're able to essentially pick the eyes out of the market. So each of those sectors are unique. So one sector that we really like is bridging mortgages. So these are typically a 65% loan-to-value ratio. So the building might be worth $1 million. They're wanting a loan of $650,000, so 65% LVR. It's a 12-month term, director's guarantees or personal guarantees, the strong alignment of interest, first mortgage security over the property, no construction, they're not knocking it down and rebuilding it. So we like those transactions because, firstly, alignment of interest, there's an asset there that we're lending conservatively against. But scenarios do occur. There might be an unforeseen personal issue with the borrower. And that's where all the other risk mitigants that we put in really come into play. So firstly, in that particular scenario, we have got a first ranking security over the property. So if in the event they don't pay, there is protections there for us to obviously compel the borrower to realise that security to repay our loan. From a portfolio perspective, though, we also think very much around, what happens if that security, there's an issue in selling it or whatever? And that's why we also then have a second line of defence, which is very much around taking small chunks of many, many loans so that even in the event there's some idiosyncratic risk with that one property and they have trouble selling it or they don't get as much as what we think they should, from a portfolio perspective, investors are very much protected because it's a very small part of the aggregate position. And that's why over our sort of 6.5 years, we've never had a negative return from credit. So it's been very robust by spreading your bets, adding that diversification, having a security that you can rely on, and having that strong alignment of interest. And also, to be honest, it's very much around just being active in managing these things. When we see there's an issue, we're on it straight away. I mean, this is all that we do. And that's, the sort of the squeaky wheel gets the oil. And that's very much how we work.
Yeah, it's a good bit of colour around that. So regarding duration, so a number of our clients really do like this lending space, both privately. A lot of our clients lend privately and also in markets. They always find duration's the biggest thing because, different risk profiles, as you can appreciate. So we're seeing a lot of people out there, or a lot of fund managers looking for about 18 months, like lock-in, quarterly, and a couple out there for 3 years, and a couple of the private ones are substantially longer, but phenomenal infrastructure assets are available. So the biggest question that I always get asked is, how do you manage to have your redemptions only 1 month? Like you can be in and then out again within a month. How do you make that work?
So there's we have our own views on lockups, and I think they are appropriate in some circumstances. I do sometimes question the motives of the manager in locking in that capital, but outside of that, there's really 3 lines of defence that we incorporate into how we construct the portfolio to give investors that liquidity. So the first one is, there's thousands of these underlying loans that are constantly being repaid. So on an ongoing basis, we're having money being returned to us and we're reinvesting that with new client monies that is coming in. If there is a redemption and an investor wants some money out, we can simply just invest less to meet those redemptions. And in our 6.5-year track record, we've never not met a redemption, even through what's been quite a sort of turbulent time over that period. The other feature of the fund is that we also target a 5% cash holding. So that's cash at bank. So that also promotes natural liquidity there to pay for redemptions as and when they occur. And then from a third perspective, we're also very careful in how we sell the fund. This isn't an enhanced cash fund. We're not saying to people, come in, come out month by month. This is very much a core holding invested portfolios, and we've been very deliberate in attracting investors that see it not as a piggy bank that can be raided whenever they want, but if they need liquidity, there is liquidity there. So I think those 3 things are very deliberate strategies by us, but do create that monthly ability to either come in or redeem from the fund.
So since we're talking about the structure of the fund, one cheat question we always love to ask is essentially, how are you remunerated? Because what we find by that question is an investor understanding exactly how you're remunerated means how you're aligned with the fund, right? So how does the remuneration structure work within the fund?
So there's really a few elements to it. So firstly, all our fees are fully disclosed. There's no below-the-line fees. There's no sort of, questionable tactics by us around the fees. We very much believe in that transparency. The fees that we charge is really broken down into 2 components. But at the starting point, we believe for a fund targeting the RBA cash rate plus 5% net of fees, a fee of 1% we think is fair. We think that's the right level that balances the effort involved first and the value we create to investors. That's kind of the natural balance. That's the right level of fees. So when we started the fund, we spoke to a lot of investors, both small and large. And what it was common is that they liked 2 things about a fee. They like to know that you can keep the lights on with a base fee. But secondly, they want to know there's an alignment there. So we've got the fee essentially split in half. So it's 0.5% base fee and then 10% performance fee over the RBA cash rate. So essentially, if we deliver the RBA cash rate plus 5%, we're getting 10% of that 5%, which is another 50 basis points. And then there's a small expense recovery fee that just pays for some of the trust costs. So we think it's quite compelling because it does create alignment, but also gives the business stability that it needs to hire top talent, reinvest in infrastructure, technology, etc.
We're talking off air, and I really hope you can elaborate more on this point regarding that structure. You were saying that you don't really have that high of a watermark in general because of what you're trying to achieve you were saying something along the lines of if you put that in the current vehicle, then it might incentivize to take more risk in the portfolio, which is not what you're currently about. So do you mind just giving a bit of color around that?
Yeah, so I believe it was in relation to talking about where the high watermark set. So having the benchmark that we outperform of the RBA cash rate can be seen as quite low. People say, well, why is it so low? And I guess for us, it's not why is it so low. It's you don't want to have it too high, because some people will say, well, it should be over cash plus 5. You should get a higher performance fee. And for us, all that does is incentivize additional risk taking when we're near cash plus 5, because we think, well, if we're just a bit over cash plus 5 and get all these great performance fees. And I think we've spent a lot of time thinking, how do you promote the right mindset right from inception to deliver the right results? And one thing we thought about is, how do you fairly sort of deliver an outcome for the business and our shareholders, but also make sure that we're not influenced in our investment decision making to think about that. So I don't know if that really answers it, but I guess it's making sure that we're not doing anything that incentivizes risk taking, because that's exactly against what the sort of core philosophy of the business is.
Yeah, thank you very much for elaborating on that. Let's do a bit of a pivot to macroeconomics. Always the fun part of the conversation. There's a lot happening in the industry right now. Past 2 years, huge amount of stimulus has been pumped in. Then they, took it all back. And there's a lot of commentators saying around town that if they increase rates by a particular amount, Armageddon, or might be not so bad. So what's your opinion on the rising rate environment we're currently seeing, and how may that impact who you're lending against and the fund?
I think you're exactly right. There's sort of two elements to that. There's sort of a commentary on what we think of the environment, and then the second is sort of implications for the fund. So if I can break it down accordingly, I think people are very, the reason why there's such rapid increase in cash rates globally, and each country is unique in the factors that they face, but is because there's such strong economic activity and growth, and typically such low levels of unemployment. So the environment is actually, from a fundamentals, actually very, very strong, and they're trying to cool that down. Whether there's a policy mistake and they get too aggressive in any one country and that has a domino effect, or globally we central banks get too aggressive on managing inflation, that's a separate question. But right now we've got great fundamentals for lending, and you can see that in a lot of the statistics, where we've got very low rates of unemployment, 3.5%. You've had a big shift from part-time to full-time employment, very strong rates of employment growth from females locally. So there's a lot of very good signals to say the employment market is very, very strong. And that is very good for us. If you then look out and sort of think about some of the other factors, you've got declining consumer sentiment, business sentiment, investments. Some of those sort of forward-looking indicators are a little bit more worrisome. So I guess from where we are, it's a very good environment, but it does highlight that we're at a little bit of a turning point now, where we've had very strong level of stimulus, we've had very accommodative policy. The new environment isn't going to be the same as that, and I think that just warrants that additional level of caution. I think there's some interesting things, particularly that's going to happen globally. Everyone's very sort of fixated on the US and where they're at. I think Europe's going to be very interesting. After a long period of zero interest rates, they're talking about potentially 150 basis point of cash rate increases before the end of the year. So that's going to be quite a big shift for them, and we can already see other areas of Asia lifting rates aggressively. So from a macro perspective, I think you can't look backwards to think about what rhymes going forwards. I think it's a new environment, and I think investors need to be very cognizant of that, and perhaps not just apply historical asset allocations, but think more diligently about that. from a portfolio perspective, how we're thinking about it, in January, we produced a client note and we talked about the different scenarios that we've been thinking through, stress testing, modelling, etc. One of them was a high interest rate, high inflationary environment. And that scenario is no longer a scenario, it's very much reality. So we've done a lot of work in positioning the portfolio for these rising interest rates. And you can see, this month we've delivered 55 basis points. So the benefits of that planning have very much come through into investor returns. I think going forward, we're very cognizant of the risk. We're very careful around that. But fundamentally, a higher level of interest rates is good for us because it delivers typically a higher rate of return to our investors. So it's a very favourable environment if you make sure you're well prepared for it in advance. And I think we've done a reasonable job at doing so.
And that leads me into my last question. How long do you think this beautiful opportunity of what the bank has created by essentially saying we do not want this level of risk on our books, fund managers, please take it. They've just opened up a door, and a number of people like yourself have stepped in, and our clients are very happy about it. But how long do you think they're going to keep this portal, I suppose, open for? Do you think it's going to be closed anytime soon, or what do you think? Yeah,
it's funny. I think there's two things, and I might challenge you on one thing there, Murdoch, and that is going back to the 65% LVR mortgage. I don't think that is particularly high risk. I think when you have a existing house, a common house in a common suburb where there's a high degree of liquidity, yes, the property market's going through some changes, but at 65% LVR, I think you'd pretty readily find a buyer for that type of property. So I don't think it's around they're pushed outside the banking system because they're high risk. I think they're pushed outside the banking system because people typically they want two things. They want flexibility and they want speed. Right, so a lot of the borrowers that are going to these non-banks, they're happy to pay away for greater flexibility because their situation might be unique. Or most commonly in this sector, we're seeing people are buying a property and they, part of them getting a good deal on a property is that they can move very quickly. They can move quicker than other people that are bidding in the process and therefore secure the property potentially at a discount, warranting paying higher interest rates. So I'm not convinced it's pushed outside the banking system. I just think maybe the banking system doesn't suit all participants and therefore it creates this opportunity. In terms of how long the window's open, lending has been around since the start of civilization. It's obviously the stamping of coins and so forth, but around that time there was elements of lending practices there. So I don't see it lending, and particularly non-bank lending, to be a short-term occurrence. If anything, I think it's just going to continue to grow and perhaps even resemble elements of the US system and Europe as well, for that fact. Will there always be a need for participants like ourselves who are, highly skilled, highly experienced in providing capital and who can move quickly and provide financing in a way that's, attractive from an investor rate of return? I don't think that's going away. And secondly, from an investor perspective, will there continue to be a need to have a product that delivers strong income but has capital stability elements? I can't see that going away. So yes, we need to change and evolve with the market to stay relevant to our investors, but I don't think this type of fund and the target market we're targeting will be going anywhere. In fact, we are experiencing incredible growth, and that's been evident in that sort of 6.5 years since we started.
Well, Josh, thank you very much for coming onto the Rate of Change and sharing your thoughts with us. And I hope you have a great day.
Thanks, Murdoch. Thanks for having me. Cheers.
Take it easy. Bye.
Any views expressed in this recording do not represent the view of any other third party and are the sole personal opinions of the speaker. Any reference to financial product does not constitute advice or recommendation, and before any action, you should seek proper advice from your financial professional. Australian listeners should head to www.moneysmart.gov.au to find more information on obtaining financial advice. To get in touch with York, head to our website www.yorkwealth.com.au.